Stop what you're doing. If you track government infrastructure stocks, you absolutely need to hear this. We are looking at a scenario where the private prison industry might be about to completely eliminate the private prison part of their business model. Now, I know retail investors often run for the hills because of the massive political risk in this sector, but legendary investors like Warren Buffett and Peter Lynch always taught us to look for unloved companies hiding massive, unlockable cash flow catalysts. Well, last week, I ran the GEO Group's Q1 2026 earnings through the ringer, and what I found literally blew my mind. By the end of this explainer, you're going to know exactly how GEO is executing a massive deleveraging event that could permanently reshape its future. Welcome to the explainer. Today, we're unpacking the fascinating business mechanics and unexpected financial surge of the GEO Group.
Okay, so let's just dive right into this highly counterintuitive premise. I want you to ask yourself a really bold question. Why on earth would a private prison company aggressively try to sell off its own prisons? I mean, it sounds totally backwards, right? It's like a restaurant selling its kitchens. But today, I'm giving you a clear, actionable framework to understand how government policy mechanically translates straight to their bottom line. They are basically looking to transform from heavy real estate landlords into asset-light software and service providers. And understanding this strategic twist, that's the master key to unlocking GEO's recent blowout quarter.
Let's start with a number that'll probably make you do a double take: $705.2 million. That is GEO's Q1 2026 revenue. It jumped a massive 17% year over year, completely crushing market expectations. Now, this growth, it definitely wasn't an accident. It was actually driven by some huge contract awards and activations that they secured throughout 2025, and those are finally normalizing and hitting the balance sheet this year.
But honestly, the real story is hidden just beneath that top-line revenue number. Their adjusted EBITDA rocketed up 32% to $131.4 million. Now, bringing in more revenue is always great, sure, but a 32% jump in earnings, that shows massive, fundamental margin expansion. They're literally making significantly more money on every single dollar that comes through the door.
Section 1. Leadership and Strategy Shift. The founder returns to the helm. Because a turnaround like this, it doesn't just happen in a vacuum. On February 6th, CEO J. David Donahue announced his retirement. And then, less than a month later, founder George Zoley returned to the helm as CEO. What's absolutely fascinating here is the rapid transition back to the founder. He didn't just come back to keep the seat warm either. He immediately put his foot on the gas for shareholder value. Right in Q1, GEO initiated a very aggressive $50 million share repurchase program, buying back 3.6 million shares. So the founder is back, and he is betting heavily on his own company. Let's move to Section 2, the electronic monitoring boom and margin expansion in the ISAP program. We really need to unpack exactly how they achieved that 32% EBITDA jump. A really massive piece of that puzzle comes from their electronic monitoring contracts, specifically the ISAP program for the non-detained docket. Now, while usage of their SmartLink mobile app, which is a lower pricing tier, dropped to 131,000 participants, usage of GPS ankle monitors absolutely surged. We're talking a jump from 17,000 to over 48,000 participants, and those devices represent a much higher pricing tier. So the crucial takeaway here is that even with overall participant counts staying relatively flat, GEO is capturing higher revenues and expanding margins just by shifting users to more intensive, higher-margin GPS monitors. And then we have this fascinating, almost ironic twist. During the quarter, the national ICE detention census actually dropped from 24,000 down to 21,000. Now, conventional wisdom says a lower population means less profit, right? But this pause in rapid intake actually gave GEO a highly profitable breather. Less intake processing, fewer housing assignments, and way fewer off-site medical visits drastically reduced their labor and overtime costs. So mathematically, lower populations actually resulted in higher margins for the quarter. Section 3, Navigating ICE and Politics. The business mechanics of border policy. Let's zoom out and look at the macro landscape. Despite operating in a highly complex political environment and an 82-day partial DHS shutdown that delayed some payment timings, GEO's contracts are remarkably insulated. Why? Because ICE operations are designated as essential public safety services. Basically, the lights have to stay on. Furthermore, Congress secured $45 billion for detention via the Budget Reconciliation Bill, and that funding is available all the way through September 2029. Currently, the national ICE population sits at around 58,000 across 225 disparate locations. which leads us directly to their next massive growth opportunity. The federal government actually wants to consolidate those 225 locations and expand to 100,000 bed capacity nationally. Now, while GEO currently has 26,000 active ICE beds, they also have 6,000 idle high-security beds. These are former U.S. Bureau of Prisons facilities that are perfectly suited for current government needs, and right now they're sitting completely empty.
So why does that matter? Well, to put a dollar figure on it, $300 million. That is the estimated annual incremental revenue GEO could generate if they simply reactivate those 6,000 idle beds. The physical assets are already built and ready to go. If the government calls, GEO just flips the switch, turns the lights on, and $300 million drops straight onto the top line.
Let's transition to Section 4, the ultimate asset sale, from real estate owners to service providers. Now we arrive at the absolute most fascinating strategic pivot mentioned in the entire Q1 call. This is a counterintuitive premise I hooked you with at the very beginning, the potential sale of physical prisons back to the government. CEO George Zoley was explicit about their true identity moving forward. He stated they consider themselves primarily a support services operator. They want to make sure they continue providing support services at any facility they might sell to ICE. Basically, they don't want to carry the heavy burden of being real estate landlords anymore. They want to run the highly lucrative asset-light management contracts. So you might be wondering, why on earth would the government want to buy these facilities from them? Well, it actually comes down to constitutional law. Federal ownership invokes the Supremacy Clause, and that provides a federal constitutional shield against state-level interference, essentially blocking aggressive state-level litigation regarding medical services, food, and day-to-day operations. By owning the turnkey facilities outright, the federal government removes a massive layer of legal friction, and that makes GEO's properties incredibly valuable targets for acquisition.
Okay, so here is the ultimate 4-step framework you need to take away from this explainer. Step 1, GEO sells physical facilities to ICE at a premium. We're using their recent lot and facility sale at $130K per bed as a solid baseline. Step 2, they renegotiate to retain the exclusive high-margin support service contracts. Step 3, they instantly eliminate heavy property taxes and depreciation costs from their books. And Step 4, they use those massive cash proceeds to aggressively pay down their debt and buy back stock. If GEO manages to execute this playbook, it is a massive deleveraging event that will completely transform their balance sheet.
Section 5, Credit Upgrades and the Future. Wall Street takes notice. And let me tell you, Wall Street is absolutely paying attention to this cash flow generation and debt repayment strategy. S&P Global Ratings has officially validated GEO's financial turnaround. They revised their outlook from stable to positive and bumped their unsecured debt rating up to B+. Through aggressive debt repayment, GEO has successfully maintained their adjusted net leverage well below 4x. It's actually sitting at a very healthy 3.2x right now. And because of all these converging factors, management just raised their full-year 2026 guidance to between $525 and $545 million in adjusted EBITDA. I'm going to leave you with this final thought to chew on. We might be watching the complete structural evolution of the government-contracted infrastructure space right before our eyes. Is the future of this industry purely in high-margin support services, with private companies owning zero actual prisons? It is a brilliant pivot that could completely rewrite the rules of their sector. Thanks for joining me to break this all down, and I'll catch you on the next explainer.